What if I told you that being good with money has almost nothing to do with how smart you are? You can know every investing formula, graduate from a top business school, and still end up broke. Meanwhile, someone with an average income, no fancy degree, and no complex strategy quietly builds real wealth and keeps it. That's the uncomfortable truth behind money. And that's exactly what The Psychology of Money by Morgan Housel is about. This book isn't about picking stocks, timing the market, or getting rich overnight. It's about how your behavior, emotions, and personal experiences quietly control your financial future, often without you realizing it. Because here's the thing, people don't make financial decisions on spreadsheets. They make them based on fear, ego, envy, past trauma, optimism, and stories they tell themselves. Why do smart people take stupid financial risks? Why do some people never feel rich, no matter how much they earn? Why does one bad decision erase years of hard work? Housel argues that money success is less about intelligence and more about patience, humility, and self-control. It's about knowing when enough is enough. It's about understanding that survival matters more than returns. And it's about realizing that wealth is often invisible because the richest people don't need to prove it. This book changes how you see spending, saving, investing, and even happiness itself. So if you've ever wondered why money feels stressful, why you feel behind even when you're doing okay, or why financial advice seems simple but feels impossible to follow, stay with me, because by the end of this summary, you won't just think differently about money. You'll understand why you make the decisions you do and how to finally build wealth that lasts. Let's begin. The core idea of Chapter 1 is simple but powerful. People make financial decisions based on their own life experiences and from their point of view. Those decisions make sense. Morgan Housel opens the book by explaining that when it comes to money, there's no such thing as a single right mindset. Everyone views risk, opportunity, and reward through the lens of what they've personally lived through. And because no two people experience the world the same way, no two people think about money the same way either. Housel points out that most financial advice assumes people are rational. In reality, people are reasonable, not rational. They don't make decisions based on spreadsheets or historical averages. They make decisions based on emotions, memories, fear, and past outcomes. For example, someone who grew up during the Great Depression may see the stock market as dangerous and unpredictable. Meanwhile, someone who started investing during a long bull market may believe stocks always go up. Both views feel logical to the people who hold them because their experiences support those beliefs. This explains why two investors can look at the same data and make completely opposite choices. Housel uses historical context to reinforce this idea. He explains that a huge portion of today's financial rules, behaviors, and fears were shaped by events like the Great Depression, World War II, and periods of extreme inflation. If you didn't live through those moments, it's hard to truly understand why older generations think the way they do about money. The key lesson here is that financial decisions are deeply personal. People aren't crazy for acting the way they do with money. They're reacting to the world as they experienced it. This insight matters because judging others' financial decisions often leads to bad advice and poor expectations. What feels safe to one person may feel reckless to another. What looks conservative may actually be aggressive depending on someone's history. Housel also turns this idea inward. Understanding that your own financial beliefs are shaped by limited experiences can help you become a better investor. Your personal timeline may be short compared to financial history. Just because something worked during your lifetime doesn't mean it always will. The chapter ends with a critical takeaway. The most important part of financial success is not intelligence, but humility. Knowing that you don't see the full picture helps you manage risk better, avoid overconfidence, and make decisions that are sustainable over the long term. In short, Chapter 1 sets the foundation for the entire book. Money isn't just about numbers. It's about people. And once you accept that no one's crazy, they're just shaped by different experiences, you start making smarter, more compassionate, and more realistic financial decisions. In Chapter 2, Morgan Housel explores a critical but often ignored truth about success and failure, luck and risk play a much bigger role than we want to admit. Most people like to believe that financial success is purely the result of hard work, intelligence, and good decisions. And while those things matter, Housel argues they are only part of the story. The other part, often invisible, is chance. He begins the chapter with the story of Bill Gates. Gates is one of the most successful people in history. But Housel points out that Gates also benefited from extraordinary luck. He attended one of the only high schools in the world at the time that had access to a computer. He grew up near a major tech hub. He was born at exactly the right moment for the personal computer revolution. None of these factors diminish Gates' skill, but they show that timing and randomness matter. At the same time, Housel introduces the idea of risk, using the example of Kent Evans, one of Bill Gates' early business partners. Evans was extremely talented and driven, but he died in a mountain climbing accident before Microsoft took off. His lack of success had nothing to do with poor decisions, it was pure bad luck. The key message is this: success is never 100% skill, and failure is never 100% stupidity. This matters because people often draw the wrong lessons from outcomes. When someone becomes wealthy, we assume everything they did was right. When someone fails, we assume they made terrible decisions. In reality, luck and risk quietly influence both outcomes. Housel explains that focusing too much on extreme examples, either wildly successful people or total failures, can lead to dangerous conclusions. Survivorship bias makes us copy the behaviors of winners, without seeing how many people tried the same thing and didn't make it. The practical takeaway is humility. Recognizing the role of luck should make you less arrogant about your success and more compassionate toward others who struggle. It should also make you cautious about over-optimizing your strategy based on limited data. Housel also argues that understanding risk is essential for long-term survival. Risk doesn't always announce itself. It often comes from rare, unpredictable events that no one plans for. You can do everything right and still experience setbacks. That's why resilience matters more than perfection. Instead of trying to eliminate randomness, which is impossible, Housel suggests building systems that can survive it. That means avoiding decisions that can wipe you out completely, even if they offer high rewards. Chapter 2 reinforces one of the book's central themes. Financial success is about staying in the game long enough for luck to work in your favor, while avoiding risks that end the game entirely. In short, this chapter teaches you to respect randomness, learn from patterns without worshiping them, and design your financial life with room for both luck and risk, because both are always present, whether you acknowledge them or not. Chapter 3 focuses on one of the most dangerous forces in finance: the inability to know when you have enough. Morgan Housel opens this chapter with the story of Rajat Gupta, a highly successful businessman and former managing director at McKinsey. Gupta was already wealthy, respected, and influential, yet he was later convicted of insider trading, not because he needed money, but because he wanted more. Housel uses this story to illustrate a critical point: the hardest financial skill is not making money, but keeping it. And the fastest way to lose what you have is to chase more when you already have enough. The chapter argues that many financial disasters are not caused by ignorance or laziness. They're caused by greed combined with ego. People who already won the game keep playing because they compare themselves to others, raise their lifestyle expectations, or feel pressure to prove something. Housel introduces the concept of relative success. No matter how much you have, there will always be someone with more. If your happiness depends on outperforming others, the finish line keeps moving. That's how people with millions can still feel poor and take reckless risks to close an imaginary gap. A major theme in this chapter is the cost of chasing excess. When people push beyond what they need, they often expose themselves to unnecessary risks. These risks don't offer proportional rewards, but they can cause catastrophic losses. Housel makes a clear distinction between enough and too much. Enough means having what you need to live comfortably, securely, and independently. Too much is when additional wealth no longer improves your life, but increases stress, risk, and dissatisfaction. He argues that knowing when to stop is a form of strength, not weakness. Society often praises ambition without limits, but financially, the ability to say "I don't need more" is what preserves wealth over time. The chapter also touches on envy as a powerful motivator. Envy pushes people to make decisions that don't align with their actual needs or values. Instead of asking, "What do I want?" people ask, "How do I compare?" Housel emphasizes that financial success should be measured by control over your time and decisions, not by how much you can accumulate. When people ignore this, they trade freedom for status. The key lesson of Chapter 3 is simple but uncomfortable. There is no reason to risk what you have, and need for what you don't have and don't need. Knowing what enough looks like in your life creates a boundary. That boundary protects you from greed, comparison, and decisions that can undo years of progress. This chapter reinforces the idea that wealth is not about maximizing numbers. It's about minimizing regret. And the most common regret in money is realizing too late that you had enough, but didn't recognize it. Chapter 4 explains one of the most important but misunderstood forces in finance, compound growth, and why the human mind struggles to truly understand how powerful it is. Morgan Housel starts with the example of Warren Buffett. Buffett is one of the richest investors in history. But Housel points out something surprising. The majority of Buffett's wealth came after his mid-60s, not because his investing skills suddenly improved, but because he stayed invested for an unusually long time. Buffett didn't just earn high returns. He earned good returns for a very long time. This leads to the core lesson of the chapter. Time is the most important ingredient in compounding, and it matters more than intelligence, strategy, or even extraordinary returns. Housel explains that people often underestimate compounding because growth is not linear. The early years feel slow and unrewarding. Progress appears insignificant, which causes many people to give up too early. But compounding works quietly at first, then accelerates dramatically later on. This misunderstanding leads people to chase shortcuts, high-risk investments, market timing, or complex strategies when the real advantage comes from patience and consistency. Another key idea in this chapter is that success from compounding depends more on endurance than brilliance. You don't need to be a genius investor. You need to avoid being wiped out. The biggest enemy of compounding is interruption panic selling, leverage, or catastrophic losses that force you out of the game. Housel emphasizes that good investing is often boring. Steady contributions, moderate returns, and long-term discipline don't feel exciting, but they are far more powerful than dramatic wins followed by setbacks. He also highlights a psychological challenge. Humans are wired to respond to immediate rewards, not delayed ones. This makes it difficult to appreciate compounding, which rewards patience over decades, not weeks or months. The chapter makes it clear that the goal is not to maximize short-term returns, but to maximize the length of time you can stay invested. Even small differences in annual returns become enormous over long periods when compounded. Housel contrasts this with people who take excessive risks to accelerate growth. While those strategies may work temporarily, they often increase the chance of failure, which completely destroys the compounding effect. The lesson applies beyond investing. Compounding affects careers, relationships, habits, and learning. Small improvements, done consistently over time, create results that look extraordinary in hindsight. Chapter 4 reinforces a central theme of the book. Financial success is not about doing extraordinary things, it's about doing ordinary things for an extraordinarily long time. In summary, confounding compounding teaches that the most powerful force in money is time combined with patience. If you respect compounding, protect yourself from ruin, and stay in the game long enough, the results can far exceed anything that skill alone could produce. Chapter 5 draws a crucial distinction that many people overlook. Getting wealthy and staying wealthy require completely different skills. Morgan Housel begins by explaining that building wealth often involves taking risks, starting a business, investing aggressively, or making bold career moves can help you accumulate money. These actions usually require optimism, confidence, and a willingness to accept uncertainty. But once you have money, the rules change. Staying wealthy is not about taking big risks, it's about survival. It's about protecting what you already have. And the skills that helped you get rich can actually work against you. When the goal shifts to preservation, Housel emphasizes that many financial failures happen, not because people didn't know how to make money, but because they didn't know how to keep it. History is full of people who earned fortunes and then lost them due to overconfidence, leverage, or the belief that past success guaranteed future results. The central idea of the chapter is this: survival matters more than returns. You don't need to earn the highest possible return every year. You need to avoid decisions that can permanently remove you from the game. Because once you're wiped out, skill no longer matters. Housel introduces the concept of a margin of safety. This means leaving room for things to go wrong because eventually something will. Markets crash. Businesses fail. Unexpected events happen. Those who survive are not the ones who predicted every crisis, but the ones who were prepared for uncertainty. He explains that staying wealthy requires a combination of humility and caution. Humility to admit that the world is unpredictable. Caution to avoid leverage, excessive risk, and dependence on perfect conditions. Another key insight is that longevity creates compounding. The longer you stay invested, the more powerful compounding becomes. But compounding only works if you're still standing, taking risks that can cause permanent damage even if they promise higher returns undermines the entire process. Housel also points out that many people confuse boldness with intelligence. In reality, boring strategies often work better over the long term. Simple saving habits, diversification, and patience don't attract attention, but they dramatically increase the odds of survival. The chapter contrasts two mindsets: the optimist who believes everything will go right, and the survivor who plans for things to go wrong. Housel argues that successful long-term investors balance optimism with paranoia. They hope for growth, but they prepare for setbacks. The lesson of Chapter 5 is clear. Financial success is not about constantly winning. It's about avoiding catastrophic loss. Getting wealthy can be exciting. Staying wealthy is often quiet, disciplined, and conservative. But it's that discipline protecting downside, respecting uncertainty, and prioritizing survival that allows wealth to last across decades. In short, this chapter teaches that the most underrated financial skill is not making money, but keeping it. Chapter 6 explains a counterintuitive truth about investing and success. A small number of outcomes often account for the majority of results. In finance, these rare events are called tail events, and they matter far more than most people realize. Morgan Housel starts by pointing out that in many areas of life, especially investing, success is not evenly distributed. Most stocks, businesses, and ideas produce average or poor results. A tiny fraction produce extraordinary outcomes, and those few winners drive nearly all long-term returns. Housel uses the stock market as a key example. Research shows that the majority of publicly traded stocks fail to outperform treasury bills over their lifetime. Yet overall markets rise because a small percentage of companies generate massive gains. These outliers, companies like Apple, Amazon, or Google, carry the entire market forward. The lesson is clear: you don't need to be right most of the time to succeed. In fact, many successful investors are wrong more often than they are right. What matters is that when they are right, their winners are big enough to outweigh all the losses. This idea also applies to careers and entrepreneurship. A person may try many things that don't work: projects, jobs, businesses, but one or two successful decisions can define their entire financial outcome. Failure is not just common, it's expected. Housel argues that people often misunderstand this pattern. They expect consistent success and become discouraged by repeated failures. But in systems driven by power laws, failure is the cost of admission. You have to tolerate many losses to capture the few big wins. Another key takeaway from the chapter is that the distribution of outcomes is not symmetrical. Losses are usually limited, but gains can be unlimited. That asymmetry is what makes patience and persistence so powerful. However, this only works if you survive long enough. Housel ties this back to earlier themes. Avoiding ruin is essential. If you take risks that eliminate you from the game, you'll never benefit from tail events. But if you manage risk, stay diversified, and keep going, you give yourself repeated chances to catch a rare winner. The chapter also explains why judging decisions based on short-term results is misleading. Most good strategies look like failures for long periods. It's only in hindsight that the impact of tail events becomes obvious. This is why copying others can be dangerous. You may see someone's success without seeing the many attempts that didn't work. The visible outcome hides the invisible failures that made it possible. The core message of Chapter 6 is this: long-term success comes from letting a few great decisions overpower many average or bad ones. You don't need perfection. You need endurance, humility, and a system that allows upside while limiting downside. In summary, Tales. Yuan teaches that success is not about avoiding failure, it's about structuring your life and finances so that failure doesn't stop you, and one big win can change everything. Chapter 7 introduces what Morgan Housel considers the highest form of wealth: freedom. Not luxury, not status, not expensive things. Freedom, in this chapter, means control over your time, the ability to decide what you do, when you do it, and who you do it with. Housel argues that most people think money's main purpose is to buy stuff, but the real value of money is that it gives you options, it gives you independence, and it reduces your dependence on things you don't want to do. He explains that happiness comes from autonomy. Humans are wired to want control over their lives. When that control is missing, when you're forced to work a job you hate, answer to people you dislike, or live under constant financial pressure, stress and dissatisfaction increase. Regardless of income, the chapter makes an important distinction. Wealth is not about what you own, but about what you don't have to do. Housel connects this idea to saving. Saving money is often framed as sacrifice, but in reality, saving is purchasing future freedom. Every dollar saved is a small vote for independence later in life. He also challenges the idea that people must maximize income to be happy. Instead, he argues that aligning lifestyle expectations with financial reality creates flexibility. Lower expenses require less income, which creates more freedom. A major theme in this chapter is time. Money can be replaced. Time cannot. When people trade all their time for money, especially beyond what they need, they often lose the very thing money is supposed to provide. Housel points out that many people stay trapped in jobs or lifestyles not because they lack ability, but because they lack financial margin. Living paycheck to paycheck removes choice. Even a high income doesn't guarantee freedom if spending rises just as fast. The chapter also touches on the psychological comfort of knowing you can walk away. Even if you never quit your job, knowing you could gives you confidence, patience, and leverage in decision-making. Housel reinforces that freedom is relative. It doesn't require extreme wealth. It requires enough savings to cover your needs and enough discipline to avoid lifestyle inflation. He also warns against confusing freedom with early retirement or doing nothing. Freedom doesn't mean stopping work. It means working on your own terms. The core message of Chapter 7 is that the purpose of money is not to impress others, but to give you control over your life. When people understand this, their financial priorities shift. They focus less on visible success and more on flexibility, security, and peace of mind. In summary, freedom reframes wealth as the ability to choose, and the most valuable thing money can buy is not consumption, it's independence. Chapter 8 explains a psychological trap that quietly shapes how people spend money and measure success: the man in the car paradox. Morgan Housel introduces a simple scenario. Imagine seeing someone driving an expensive luxury car. Most people think that person must be successful. But Housel argues that the driver's experience is different. The driver isn't thinking about how impressive the car looks, they're thinking about how they feel driving it. This creates a paradox. When you buy status symbols, you're trying to impress others, but those people are focused on themselves, not you. The observer sees wealth. The owner feels consumption. Housel's point is that admiration is rarely directed at the person who owns expensive things. Instead, people imagine themselves in that position. They don't want your car, they want the lifestyle, respect, or freedom they believe the car represents. This insight explains why spending money to gain admiration almost never works. The social reward people expect from visible wealth is far smaller than they imagine. Most people are too busy comparing themselves to notice or care. The chapter ties this idea to lifestyle inflation. Many people increase spending not to improve their own happiness, but to signal success to others. Bigger houses, luxury brands, and expensive cars become tools for validation rather than genuine satisfaction. Housel argues that this mindset leads to a dangerous cycle. the more you spend to look successful, the less wealth you actually build. And the less wealth you have, the less freedom and security you enjoy. A key theme in this chapter is that wealth is internal, while spending is external. Real wealth is financial independence, flexibility, and security. But those things are invisible. Spending is visible, but it often hides the absence of wealth. Housel reinforces an earlier idea: wealth is what you don't see. The money you save, invest, and don't spend is what creates long-term freedom. Yet those choices receive no applause. The chapter also explains why people often feel pressure to keep up. Social comparison pushes spending decisions that don't align with personal goals. People copy lifestyles without knowing the financial realities behind them. Housel doesn't argue against enjoying money. Instead, he encourages awareness. Ask yourself who you're trying to impress and why. If the answer isn't you, the decision may be costing more than it gives. The practical takeaway is simple: stop spending money to gain approval from people who aren't paying attention. True confidence doesn't come from visible consumption. It comes from knowing you're financially secure, independent, and aligned with your values. In summary, Chapter 8 teaches that chasing admiration through spending is a losing game. The greatest financial advantage comes from ignoring the crowd, valuing what's invisible, and building wealth that gives you freedom even if no one else notices. Chapter 9 reinforces one of the most important ideas in the psychology of money. Real wealth is invisible. Morgan Housel explains that people often confuse being rich with being wealthy. Being rich is about income and visible consumption: nice cars, big houses, luxury brands. Wealth, on the other hand, is what's left over after you spend. It's the money you save, invest, and don't touch. The problem is that wealth doesn't get attention. You can see someone's lifestyle. You can't see their savings account, retirement portfolio, or financial security. Because of this, people tend to model their behavior after what they can observe spending rather than what actually builds wealth. Housel uses a simple example. If someone earns a high income but spends nearly all of it, they may look successful, but they aren't building wealth. Meanwhile, someone with a modest income who saves consistently may appear average, but they are becoming wealthy over time. The chapter emphasizes that saving is the gap between ego and income. Saving requires humility, the willingness to not show off, not keep up, and not prove success through consumption. This idea challenges common financial advice that focuses heavily on earning more. While increasing income helps, Housel argues that spending behavior matters more than income level. High earners can be broke. Low earners can be financially secure. Another key point is that wealth is about optionality. It's about having choices. When you save money, you're buying future options: freedom to change jobs, handle emergencies, or walk away from bad situations. Housel also explains why people underestimate the power of saving. Saving doesn't feel productive because it's invisible and delayed. There's no immediate reward or recognition, but over time, it compounds into independence. The chapter ties back to social comparison. People often spend money to match lifestyles they see, without realizing that those lifestyles may be financed by debt or financial stress. Comparing visible outcomes leads to invisible problems. Housel warns that spending money is the fastest way to destroy wealth, even when income is high. The absence of visible luxury often signals discipline, not failure. He also clarifies that saving doesn't mean deprivation. It means intentionally choosing which expenses matter and which don't. Wealth grows when spending is aligned with personal values, not social pressure. The central takeaway of Chapter 9 is simple but powerful. Wealth is financial resilience. It's the ability to absorb shocks, wait patiently, and make decisions without desperation. If you judge financial success by what you see, you'll miss the point. The most financially successful people are often the least visible. In summary, this chapter teaches that the goal of money is not to look rich, it's to be free. And freedom is built quietly, through saving, discipline, and decisions no one else applauds. Chapter 10 focuses on one of the simplest but most misunderstood rules of personal finance. Saving money matters more than most people think, and it has little to do with intelligence or income level. Morgan Housel starts by challenging a common belief that saving is only possible for high earners. In reality, Saving is not about how much money you make. It's about the gap between what you earn and what you spend. And that gap exists at every income level. Housel explains that people often wait for the right time to start saving after they earn more, after debt is gone, or after life becomes more stable. But that moment rarely arrives. Expenses rise with income, and lifestyle expectations expand quickly. The key message is simple. Saving needs no specific reason. You don't save for a specific purchase. You don't save because a spreadsheet told you to. You save because saving gives you options. Housel argues that saving without a clear goal is actually powerful. It gives you flexibility for future opportunities you can't yet predict: job changes, emergencies, investments, or personal freedom. Another major idea in this chapter is that saving is a hedge against life's unpredictability. Life doesn't move in straight lines. Unexpected expenses, economic downturns, and personal setbacks are inevitable. Saving prepares you for events you can't forecast. Housel also explains why saving is emotionally difficult. Spending provides instant gratification. Saving provides delayed security. Humans are wired to prefer the present over the future, which makes saving feel like sacrifice even when it's beneficial. He emphasizes that saving is not about deprivation. It's about controlling your financial baseline. The lower your baseline expenses, the easier it becomes to save, and the less income you need to feel secure. The chapter also connects saving to independence. When you have savings, you don't need to make desperate decisions. You're not forced into bad jobs, bad investments, or bad relationships because of money pressure. Housel makes it clear that financial flexibility is the real return on saving. It doesn't show up as a flashy number, but it dramatically improves decision-making and reduces stress. He also points out that saving is often invisible and unrewarded socially. There's no applause for restraint, but the absence of recognition is exactly what allows saving to work. It keeps ego out of the equation. The chapter pushes back against the idea that financial progress requires constant optimization. You don't need perfect budgets, complex systems, or aggressive strategies. You need consistency and the willingness to live below your means. The core lesson of Chapter 10 is this: saving money creates room for error, and room for error is what allows long-term plans to survive real life. In summary, Save Money teaches that saving is not about future luxury, it's about present control. It's a tool that protects you from uncertainty, gives you options, and quietly builds the foundation for financial freedom long before wealth becomes visible. Chapter 11 explains why being reasonable with money is often more effective than being perfectly rational. Traditional finance assumes people make decisions logically, based on data, probabilities, and optimal outcomes. But Morgan Housel argues that this assumption doesn't match reality. Humans are emotional, biased, and influenced by fear, stress, and personal history. And that's not a flaw, it's a fact. The chapter's core idea is simple. A financial strategy that works in real life is better than a perfect strategy you can't stick to. Housel explains that rational decisions look great on paper. They maximize returns, minimize costs, and follow strict logic. But rational strategies often ignore human behavior. They assume people won't panic during market crashes, won't feel regret, and won't change their minds under pressure. In reality, people don't fail financially because they choose bad strategies. They fail because they abandon good strategies at the wrong time. This is where being reasonable matters. A reasonable financial plan accepts emotional limits. It may sacrifice some potential return in exchange for peace of mind, consistency, and long-term commitment. And over decades, that trade-off often leads to better outcomes. Housel gives examples of investors who choose conservative portfolios, not because it's mathematically optimal, but because it helps them sleep at night. If a strategy causes anxiety, stress, or panic, it increases the risk of bad decisions like selling at the bottom or chasing losses. The chapter emphasizes that the best plan is the one you can follow when things go wrong. Reasonable investors leave room for doubt, mistakes, and uncertainty. They accept that they don't need the highest return. They need a return that keeps them invested. Housel also points out that financial advice often fails because it ignores this reality. Advising someone to invest aggressively may be rational based on age and math but unreasonable if that person cannot emotionally tolerate volatility. Another key idea is that behavior matters more than knowledge. You don't need to understand every detail of finance to succeed. You need habits that prevent self-sabotage. Being reasonable also means avoiding extreme optimization. Trying to squeeze out every extra percentage point often adds complexity, stress, and fragility. Simpler systems tend to be more durable. Housel reinforces that markets reward patience, not perfection. Investors who stay calm, consistent, and disciplined even with average strategies often outperform those who constantly adjust based on fear or excitement. The lesson of Chapter 11 is not to ignore logic, but to respect human behavior. A strategy that fits your personality, values, and emotional tolerance is more powerful than a theoretically superior one that you'll abandon under pressure. In summary, Reasonable Rational teaches that financial success is not about being coldly logical. It's about designing decisions you can live with through fear, uncertainty, and long periods of boredom. Because in the real world, reasonable decisions compound better than rational ones you can't stick with. Chapter 12 focuses on a fundamental reality of money and history. The most important events are usually the least predictable. Morgan Housel argues that people rely too heavily on historical data to forecast the future. While history is useful, it has a major limitation: it only shows events that already happened. It cannot account for events that were so unexpected that no one could have predicted them. These surprises, however, often shape the world the most. Housel explains that major financial, economic, and social changes are often driven by rare, extreme events. Wars, market crashes, technological breakthroughs, pandemics, and financial crises tend to redefine rules, but they were largely unpredictable beforehand. The problem is that humans crave certainty. We want clear explanations and reliable forecasts. So we study the past and assume the future will behave similarly. But this creates a false sense of confidence. The chapter highlights that risk lives in the parts of history we don't see. Historical data excludes events that were too rare to repeat often. It also excludes future surprises by definition. This makes many models and forecasts fragile, even when they appear sophisticated. Housel emphasizes that financial success doesn't come from predicting surprises. It comes from being prepared for them. Instead of asking, "What's most likely to happen next?" a better question is, "What could happen that would matter the most?" This shift in thinking leads to more resilient decision-making. Rather than building plans that only work under ideal conditions, you build plans that can survive a wide range of outcomes. The chapter connects this idea to investing. Markets regularly experience crashes that fall outside normal expectations. These events don't happen often, but when they do, they dominate long-term results. Ignoring them because they're rare is dangerous. Housel also explains why people underestimate uncertainty. When something hasn't happened in recent memory, it feels impossible. But rarity doesn't mean impossibility. It just means infrequency. Another key point is that stories oversimplify reality. After surprises happen, people create narratives that make them seem inevitable. This hindsight bias gives the illusion that the future is more predictable than it actually is. The lesson here is humility. Acknowledging that you don't know what's coming leads to better financial behavior. It encourages diversification, caution, and long-term thinking. Housel argues that flexibility is more valuable than accuracy. Being slightly wrong, but adaptable is better than being precisely right under narrow conditions. This chapter reinforces earlier themes. Saving money, avoiding leverage, and maintaining room for error are not signs of pessimism. They're strategies for survival in a world driven by surprises. The core takeaway of Chapter 12 is that the future will surprise you, and that's normal. Trying to eliminate uncertainty is impossible, but you can design your financial life so that uncertainty doesn't ruin you. In summary, surprise teaches that history is an incomplete guide, forecasts are fragile, and resilience beats prediction. Financial success doesn't come from knowing what will happen next, it comes from being ready for whatever happens next. Chapter 13 introduces one of the most important but overlooked principles in personal finance: leaving room for error. Morgan Housel argues that the world is unpredictable. and no financial plan works exactly as expected. Because of this, the smartest strategies are not those that assume everything will go right, but those that can survive when things go wrong. Housel defines room for error as the gap between what you can handle and what could realistically happen. It's a margin of safety that protects you from uncertainty, bad luck, and mistakes, because all three are inevitable. The chapter explains that many financial disasters occur not because people were wrong, but because they were too confident. They built plans that only worked under perfect conditions. When reality deviated even slightly, those plans collapsed. Housel uses the concept of leverage to illustrate this idea. Leverage increases potential gains, but it removes room for error. When things go well, leverage feels brilliant. When something unexpected happens, it can cause permanent damage. The key message is clear. Room for error lets you endure volatility without being forced into bad decisions. This applies to investing, careers, and personal finances. If you need everything to go right to succeed, your plan is fragile. But if you allow for setbacks, you can keep going even when conditions are unfavorable. Housel emphasizes that volatility is normal. Market crashes, income disruptions, and unexpected expenses are part of life. Planning as if they won't happen is unrealistic. He also explains why people resist building margin, leaving money uninvested, keeping cash reserves, or accepting lower returns can feel inefficient. But that inefficiency is what buys survival. The chapter reframes conservatism. Being conservative doesn't mean you expect the worst. It means you accept uncertainty and prepare for it. Housel points out that the cost of safety is often visible, but the benefit is invisible. You notice the return you didn't earn by holding cash. You don't notice the disaster you avoided because you had flexibility. Another important insight is that psychological stability matters as much as financial stability. Room for error reduces stress and panic. When you know you can handle setbacks, you're less likely to make emotional decisions that lock in losses. Housel also connects this chapter to long-term thinking. Plans that last decades must survive unpredictable events. Maximizing short-term efficiency often undermines long-term durability. The core lesson of Chapter 13 is simple. You don't need to be right, you need to avoid being ruined. Financial success favors those who leave space for error, accept uncertainty, and design lives that can absorb shocks without falling apart. In summary, room for error teaches that margin of safety is not wasted potential. It's what keeps you in the game, and staying in the game through mistakes, surprises, and volatility is what allows long-term success to compound. Chapter 14 addresses a reality that most financial plans fail to account for. You will change over time. Morgan Housel argues that many long-term financial decisions assume a stable version of yourself, your goals, values, interests, and tolerance for risk. But in real life, people evolve. What you want at 25 is rarely what you want at 45. And what feels important today may feel irrelevant in the future. The problem is that we underestimate how much our future selves will differ from who we are now. Housel explains that people are surprisingly good at recognizing how much they've changed in the past, but very bad at imagining how much they'll change in the future. This creates overconfidence in long-term plans that lock us into commitments our future selves may regret. The chapter highlights how this shows up in money decisions. People take on long-term debt, rigid careers, or aggressive financial strategies based on current preferences, without leaving room for personal evolution. Housel points out that many regrets are not caused by bad decisions at the time. They're caused by decisions that made sense then, but no longer fit who you became. This insight leads to a key principle. Flexibility is more important than optimization. Instead of building the perfect plan for today's goals, it's smarter to build a plan that can adapt as your priorities change. This may mean choosing a less lucrative career with more flexibility, avoiding extreme leverage, or maintaining savings that allow you to pivot. Housel also discusses how lifestyle expectations evolve. People often assume they'll always want more money, more status, more consumption. In reality, many people eventually value simplicity, time, and security more than growth. This is why some people feel trapped by past financial success. High income and expensive lifestyles can reduce freedom, if they limit the ability to change direction later. Another important idea in this chapter is that long-term happiness is tied to adaptability. When your financial life allows change, you're better equipped to respond to new interests, relationships, health needs, or values. Housel connects this concept to investing. Locking yourself into strategies that only work under narrow assumptions increases regret. When circumstances shift, flexible strategies may feel conservative, but they age better over time. The chapter also challenges the idea that consistency means stubbornness. Being flexible doesn't mean lacking discipline. It means accepting that growth includes change and designing systems that allow it. The takeaway is not to avoid long-term planning, but to plan with humility. Accept that you don't know who you'll be decades from now, and respect that your future self deserves options. The core lesson of Chapter 14 is this: the best financial decisions are those that can survive changes in who you are. In summary, You'll Change teaches that life is dynamic, not fixed. Financial plans that recognize this by prioritizing flexibility, optionality, and room to evolve lead to fewer regrets and greater long-term satisfaction. Chapter 15 delivers a blunt but essential lesson. Every financial outcome comes with a price, and that price is often psychological, not mathematical. Morgan Housel explains that in finance, nothing is truly free. Higher returns, faster growth, and greater opportunity always come with some form of cost. The mistake people make is not recognizing or accepting that cost upfront. Housel argues that many investors search for strategies that offer rewards without discomfort. They want high returns without volatility, growth without uncertainty, and success without stress. But those combinations don't exist. The real question is not, what's the best return? It's, what price am I willing to pay? The chapter explains that volatility is the price of admission for investing. Market drops, uncertainty, and fear are not signs that something is wrong. They are the cost of long-term returns. If stocks didn't fluctuate, they wouldn't offer higher returns than safer assets. Housel emphasizes that the price is not paid with money, it's paid with emotions. Fear during crashes, doubt during stagnation, regret when others appear to do better. These feelings are unavoidable, and trying to eliminate them usually leads to poor decisions. A key insight in this chapter is that many people mistake the price for a fine. When markets fall, they assume something went wrong and rush to fix it, often by selling or changing strategies. In reality, the discomfort is simply the cost of participation. The chapter also highlights why people struggle to stay invested. The emotional cost feels too high in the moment, even if the long-term reward is worth it. This leads to short-term thinking and self-sabotage. Housel connects this idea to earlier themes like being reasonable over rational. A strategy may be mathematically optimal, but if you can't tolerate its price, it's the wrong strategy for you. He also explains that different people have different price tolerances. Some can handle volatility easily, others need more stability to remain committed. Neither is wrong, the key is alignment. Another important point is that the price of success is not evenly distributed over time. Most of the emotional cost is paid during bad periods, while most of the rewards come later. This mismatch makes investing psychologically difficult. Housel reinforces that long-term success comes from accepting the cost rather than avoiding it. People who succeed don't have superior forecasts. They have a higher tolerance for discomfort. The core message of Chapter 15 is this: you must view volatility, uncertainty, and stress as fees, not failures. Once you accept the price, you stop reacting emotionally, you stop trying to escape discomfort, and you stay invested long enough for the rewards to show up. In summary, Nothing's Free teaches that financial success isn't about finding painless strategies. It's about choosing which pain you're willing to endure and paying it consistently, because the returns only go to those who accept the cost. Chapter 16 explains how personal incentives and individual goals shape financial decisions, and why copying others often leads to bad outcomes. Morgan Housel starts with a simple but powerful idea: everyone plays a different financial game. Even when people appear to be doing the same thing, investing in stocks, running businesses, or building wealth, their objectives, timelines, and constraints are different. The mistake most people make is assuming that someone else's success can be directly replicated. Housel argues that financial decisions only make sense when you understand the goal behind them. Without knowing someone's incentives, risk tolerance, time horizon, or personal situation, their strategy is meaningless to you. For example, a hedge fund manager may take aggressive risks because their compensation is tied to short-term performance. A day trader may accept volatility because they don't rely on long-term compounding. A young entrepreneur may risk failure because they can afford to start over. But if you copy those strategies without sharing the same incentives, you're playing the wrong game. The chapter emphasizes that context matters more than tactics. A decision that looks smart for one person may be reckless for another. Success is not universal, it's personal. Housel explains that this is why financial advice often feels contradictory. One expert says to take risks, another says to be conservative. Both may be right for their own situation. The problem arises when people chase returns without understanding the hidden trade-offs. They see the upside but ignore the downside because it doesn't apply to the person they're copying. Another key idea in this chapter is that competition distorts behavior. When people compare themselves to others, they take risks that don't align with their own needs. They stop asking, "What works for me?" and start asking, "How do I keep up?" Housel reinforces that financial success is not about beating others. It's about meeting your own goals, whether that's security, freedom, flexibility, or peace of mind. The chapter also highlights how different time horizons create different strategies. Someone saving for retirement in 30 years should not behave like someone managing quarterly performance. Mixing those perspectives leads to frustration and poor decisions. Housel encourages readers to define their own financial goals clearly. Once you know what game you're playing, decision-making becomes simpler. You stop chasing what doesn't matter to you. The core message of Chapter 16 is this: there is no single correct way to manage money, only ways that fit or don't fit your life. Trying to optimize based on other people's rules increases risk and regret. Designing a strategy around your own incentives increases durability. In summary, You and Me teaches that financial decisions are deeply personal. When you stop copying others and start playing your own game, money becomes less stressful and far more effective. The goal isn't to win someone else's race. It's to finish your own. Chapter 17 explains why bad news spreads faster, feels smarter, and is more persuasive than good news, especially when it comes to money and investing. Morgan Housel argues that pessimism has a natural advantage over optimism. Negative stories feel urgent. They demand attention. They sound realistic, cautious, and intelligent. Optimism, by contrast, often sounds naive, boring, or blind to risk. This imbalance shapes how people think about markets, the economy, and the future. Housel points out that pessimistic narratives usually focus on short-term pain, crashes, recessions, bubbles, and failures. These events are dramatic and emotionally powerful. They happen quickly and create clear stories with villains and victims. Optimism, however, often works quietly. Progress happens slowly, unevenly, and without headlines. Economic growth, technological advancement, and rising living standards unfold over decades, not days. That makes them harder to notice and harder to believe. The chapter explains that pessimism feels safer. Expecting things to go wrong feels responsible. If disaster happens, you feel prepared. If it doesn't, no one criticizes you. Optimism carries reputational risk. If you're optimistic and things go wrong, you look foolish. This creates a bias where people overconsume negative information and underappreciate long-term progress. Housel connects this idea to investing behavior. Many investors stay out of the market because pessimistic arguments sound convincing. There's always a reason to worry: high valuations, debt, inflation, geopolitical risk. These risks are real, but they are always present. The problem is that markets don't require a perfect world to deliver long-term returns. They require adaptation, innovation, and time. Despite constant setbacks, progress continues. Housel emphasizes that optimism is not blind faith. It's a belief that over long periods, people solve problems, improve systems, and adapt to challenges. History supports this view, but only when measured over long time frames. Another key insight is that short-term losses are easier to imagine than long-term gains. A market crash can happen quickly and visibly. Compounding wealth happens slowly and invisibly. This asymmetry makes pessimism emotionally stronger. The chapter also explains why media amplifies negativity. Fear attracts attention. Attention generates clicks. This doesn't mean bad news is fake, but it does mean it's overrepresented. Housel warns that constant pessimism can lead to paralysis. When people believe the system is broken and the future is doomed, they stop investing, stop taking risks, and miss opportunities for growth. The lesson is not to ignore risks. It's to balance awareness of short-term pain with recognition of long-term progress. Housel reinforces that successful investors acknowledge problems, but don't let fear dominate their decisions. They understand that volatility and setbacks are part of the process, not signs that progress has ended. The core takeaway of Chapter 17 is this: pessimism sounds smart, but optimism makes money when it's patient, disciplined, and grounded in long-term thinking. In summary, the seduction of pessimism teaches that fear is loud, progress is quiet, and long-term success belongs to those who can tune out constant negativity without ignoring reality, because the future is rarely perfect, but it's often better than pessimists expect. Chapter 18 examines why people become vulnerable to bad financial ideas and why fear and uncertainty make us believe almost anything. Morgan Housel explains that when outcomes are unclear and the stakes feel high, people crave certainty. They want explanations, predictions, and stories that make sense of chaos. And when reliable answers don't exist, people become open to narratives that feel true even if they aren't. The chapter's core idea is this: the more uncertain the world becomes, the more confident-sounding stories gain power. Housel argues that during periods of stress, market crashes, economic instability, bubbles, or major change, people don't look for nuance, they look for clarity. Simple explanations feel comforting, especially when they promise control or insight. This is why conspiracy theories, extreme predictions, and overly confident forecasts thrive during crises. They offer a sense of order when reality feels unpredictable. The problem is that confidence is often mistaken for accuracy. Housel explains that financial markets are complex systems influenced by countless variables. No single explanation can fully capture what's happening, but the human brain prefers clean narratives over messy reality. As a result, people often believe the most persuasive storyteller, not the most accurate one. The chapter connects this behavior to investing mistakes. When markets fall, people search desperately for reasons. They latch onto explanations that justify fear or promise protection. This can lead to panic selling, market timing, or following extreme advice that sounds logical in the moment but fails over time. Housel emphasizes that stories are more powerful than statistics, especially under stress. Numbers require patience and context. Stories offer immediate meaning. He also points out that bad ideas spread faster than good ones because they appeal to emotion. Fear-based narratives travel quickly. Calm, long-term perspectives do not. Another key insight is that uncertainty lowers skepticism. When people feel lost, they stop questioning sources. They become more willing to believe predictions that confirm their emotions, especially fear. Housel warns that this mindset is dangerous because it leads to overreaction. People make permanent decisions based on temporary emotions. The chapter reinforces a recurring theme: the future is inherently uncertain, and pretending otherwise leads to false confidence. No one truly knows what will happen next, regardless of how convincing they sound. Instead of seeking certainty, Housel encourages humility. Accepting that you don't know everything reduces the temptation to follow extreme narratives. He also highlights the importance of long-term thinking. Short-term chaos often feels overwhelming, but most financial outcomes are shaped over decades, not weeks or months. The core lesson of Chapter 18 is this: when fear is high and clarity is low, your ability to stay skeptical matters more than your ability to predict. In summary, When You'll Believe Anything teaches that uncertainty creates vulnerability. The antidote is not finding better predictions, but building discipline, patience, and systems that don't depend on being right. Because in a world full of confident voices, the most powerful skill is knowing when not to believe them. Chapter 19 brings together the core ideas of the psychology of money into a single, practical framework, rather than introducing new concepts. Morgan Housel connects the lessons from earlier chapters and shows how they work together in real life. The chapter's main message is that successful money management is not about perfection. It's about behavior that is sustainable over time. Housel begins by emphasizing that financial success comes from a combination of humility, patience, and resilience. No single rule guarantees wealth. Instead, it's the interaction of many small, reasonable decisions made consistently. One of the first ideas he revisits is risk and uncertainty, because the future is unpredictable. The best strategies leave room for error. This means saving consistently, avoiding excessive leverage, and maintaining flexibility. Plans that only work under ideal conditions are fragile. Housel also reinforces the importance of long-term thinking. Compounding works only when you stay in the game. That requires emotional discipline during market volatility, and the willingness to tolerate discomfort as the price of long-term returns. Another key theme is knowing what game you're playing. Financial decisions only make sense when aligned with personal goals. Copying others without understanding their incentives leads to unnecessary risk. The right strategy is the one that fits your life, not someone else's success story. The chapter highlights the role of behavior over intellect. You don't need advanced financial knowledge to succeed. You need habits that prevent panic, greed, and overconfidence. Reasonable decisions, made consistently, outperform rational but unfollowable strategies. Housel also ties in the concept of enough. Contentment is a financial advantage. Knowing when to stop protects you from risks driven by ego, comparison, and greed. Many financial failures happen not from lack of opportunity, but from refusing to recognize when you've already won. Another important lesson is preparing for surprise. History is an incomplete guide, and rare events shape outcomes more than averages. Because of this, resilience matters more than prediction. Housel emphasizes that wealth is invisible. Real wealth is savings, optionality, and freedom, not consumption. Measuring success by what you see leads to poor decisions and unnecessary stress. The chapter concludes with a simple but powerful idea. Financial success is deeply personal. There is no universal blueprint. The goal is not to maximize returns, impress others, or avoid every mistake. The goal is to build a financial life that you can stick with through good times and bad. In summary, Chapter 19 shows that the psychology of money is not about mastering markets, it's about mastering yourself. When you combine patience, humility, reasonable behavior, and long-term thinking, money stops being a source of stress and becomes a tool for freedom. That's the book's message, not altogether perfectly, but altogether realistically. Chapter 20 closes the book with a personal and practical reflection. Instead of theory or psychology, Morgan Housel shares his own financial beliefs and rules not as universal truths, but as principles that work for him. He begins by making an important point: everyone's financial strategy should be personal. What follows is not advice meant to be copied blindly, but an example of how someone applies the book's ideas in real life. Housel explains that his main goal with money is independence. He values freedom of time and control over his decisions more than maximizing returns or chasing status. This priority shapes every financial choice he makes. One of his key confessions is that he avoids debt whenever possible, not because debt is always bad, but because he values psychological comfort. Being debt-free gives him flexibility and reduces stress, even if using leverage could potentially increase returns. He also admits that he keeps a significant amount of cash from a purely rational perspective. Holding cash may seem inefficient, but for Housel, cash is not an investment, it's insurance. It gives him room for error, peace of mind, and the ability to stay calm during market downturns. Another principle he shares is long-term investing with minimal activity. He avoids frequent trading, market timing, and complex strategies. His approach is built around patience, low costs, and letting compounding do the work. Housel emphasizes that he does not try to predict the market. He accepts uncertainty and focuses on behaviors he can control, saving consistently, staying invested, and avoiding catastrophic mistakes. He also talks about aligning money with lifestyle expectations. He intentionally keeps his lifestyle modest relative to his income. This gap allows him to save aggressively and maintain flexibility, reinforcing the idea that wealth is what you don't see. A key theme in this chapter is self-awareness. Housel knows his emotional limits. He designs his financial life around them instead of fighting them. This makes his strategy durable, not perfect, but sustainable. He reinforces that there is no best strategy, only strategies that fit individual personalities, goals, and values. What matters is not maximizing outcomes, but minimizing regret. The chapter also serves as a reminder that financial success doesn't require extreme intelligence, complexity, or constant optimization. It requires honesty with yourself and consistency over time. Housel closes the book by returning to the central message. Money decisions are not spreadsheets. They are reflections of who you are. In summary, Confession shows how the principles of the psychology of money look when applied to a real person. It reinforces that the ultimate goal of money is not to win a game or impress others, but to support a life that feels stable, flexible, and aligned with your values. The lesson is simple but powerful. Build a financial strategy you can live with, not one you have to constantly fight. And that's how the book ends, not with rules, but with perspective. The Psychology of Money isn't a book about stock picks, budgets, or financial formulas. It's a book about how people actually behave with money, and why that behavior matters more than intelligence. Morgan Housel's core message is simple. Doing well with money has little to do with how smart you are, and everything to do with how you behave. Throughout the book, we learn that luck and risk shape outcomes more than we want to admit. That compounding rewards patience more than brilliance, that survival matters more than returns, and that most financial mistakes come from emotion, fear, greed, ego, and comparison. Housel shows us that wealth is invisible. It's not the car, the house, or the lifestyle. It's the freedom, flexibility, and security you don't see. The ability to say no, the ability to wait, the ability to sleep at night. He reminds us that there's no single right way to manage money. Everyone plays a different game, with different goals and constraints. The best financial plan is not the one with the highest return. It's the one you can stick with through uncertainty, volatility, and change. This book doesn't promise to make you rich overnight. What it offers is something more valuable, a mindset that helps you avoid ruin, reduce regret, and build wealth that lasts. In the end, the psychology of money is really about understanding yourself. Once you do that, the numbers start to work in your favor. If this summary helped you see money differently, hit like so more people can find it. Subscribe for more clear, practical breakdowns of the best finance books. No hype, no jargon. And comment below, what idea from this book changed the way you think about money the most? Thanks for watching, and I'll see you in the next one.